No, I got up really early. Hey, good. Hello.
Good morning. Good afternoon. I'm sorry, Crystal. How are you?
I am good. I'm. It's Monday. That's all I
It's
can
Monday.
say.
It's
It's
Monday.
Monday.
Well, thank you for joining me for Conversations on the Patio. You look dramatically closer than I do. It's like I'm in the way background of the patio. We need to fix that. I'm gonna have to get myself one of those cool cameras that you have.
Oh
Right.
yeah, you have to get yourself a webcam.
Yeah.
So even if you lean back, it doesn't matter.
I'm still here. So
Good.
I'm excited about our broadcast today. We've got two amazing topics, one of those being value versus growth. That's about investments on a basic level. And I love talking about that stuff. So we're going to get into that. And then you suggested, and I think I put in the title, what do we do when we leave our company? And
Mm.
secondarily, how does all of that fit together inside a retirement plan? So I'm going to, if you'll allow me, I will read your bio and then we will get right into it, unless you have something to add.
I do actually have a compliment for us.
Oh,
I was speaking to one of my colleagues, and she was saying, "Oh my God, Crystal, all your podcasts are absolutely fantastic." She goes, "But the one on Monday, oh my!" She goes, "That every topic you guys have just fits a question that I have about retirement and retirement plans." And she goes, "And I
oh,
think I'm pretty savvy at putting away money for my retirement." She goes, "But." When Jane was on about Medicare, she says,
oh,
I was riveted to the
yeah,
screen. Riveted now, that's a word, right? To the
yep.
screen. So she says, I think this is really a valuable show. So I just wanted to pass that on.
Oh, thank you. I please say thank you to her for me as well, because we do a lot of work to make it happen, and I think that a lot of people. I hope that a lot of people are getting some benefit out of it, because
Well,
it is
that young
something that.
lady is. She says she was very. She walked away with a page full of notes, and
Oh,
um, and so she was very pleased. But she says I try to check in on Mondays to see the show because it's she's a business coach as well. So the stuff that I talk about on the other shows or on
mhm.
my Friday show is about business. So yes, it's great to reinforce. But this one, she goes, this is like stuff that this is not a path that I tread in. so, so it was really valuable. So hopefully our other listeners are getting the same
Yeah,
benefit out of the show as well. Just
yeah.
wanted to pass that on.
The funny thing is that most of my friends that tend to jump in and listen, they're like, "There's Jevon preaching again. We've heard this all before," but here he goes. But there are some folks that I think that are getting some benefit, and sometimes I say things in a different way than I have before, so that helps them as well. I think they go, "Oh, he hasn't said it like that before."
However, they need to take it in.
There you go. There you go. There you go.
All righty, so we can get going.
Okay, well, here's Crystal, business coach and consultant, Crystal Mitchell, coach and consultant, CEO of Mitchell Business Solutions, co-director of Recycling Black Dollars, co-host of the Business Zone with Crystal and Gilbert, that other online radio show, instructor at Mount San Antonio Community College, certified network for teaching entrepreneurship instructor, and a QuickBooks Pro Advisor financial strategist. Welcome, Crystal Mitchell, to the show.
And thank you so much. It's good to be here. Monday show is one of my favorite. Monday at 1 o'clock is one of my favorite times, A-
Ah,
and and has to be today because for whatever reason I didn't sleep well, so I was up at 5 this morning and
oh,
opening up my computer to do some work, which is really not as abnormal. But I had so much on my head and that I
yeah.
knew I had to do that I had to just wake up and start working so I could at least knock couple of things off of the checklist, the task list today. So,
So,
but I
well,
am
good.
happy to be here.
Well, I'm glad to have you here. I am Jevon Thomas, a licensed retirement plan advisor, and we're going to jump right in. We've got two really big subjects. One is uh, the concept of growth versus value. I'm going to talk about that. The other
Okay.
concept is, what do you do when you leave your company? what's going on with that 401k or that 403b, that employer-sponsored retirement plan. We're going to talk about that. So let's jump off. And I'll tell you, the reason that I like talking about value versus growth is because it's extremely, in my mind, theoretical, right? So and it is in that, when we think about the stock market, and which I'm going to suggest compensates the bond market and the investable assets out there.
Okay.
We have an issue, and that is that we think that what something is worth has something to do with what its value is. So, for example, if we suggest that something is worth X in particular dollars, then that's some indication of its actual value to us as an entity or as a thing. And that's just not true when it comes to the stock market, because something is only worth something in the market if someone else sees value and pays that amount of money for it, right? So you really can't say that the value of X is commensurate with the worth of it in the stock, in the dollar, right? So if we take a look at a house, the value may, or the worth may be $550, right? $550,000. But the value, depending on who you are, and it really does depend on who you are, could be dramatically less or dramatically more. If your house is, if this house is going to be owned by parents who are 60 years old and this is their nest and they're going to pass away there, or welcome their grandkids there, or have marriages there, or build incredible memories there, that's one thing. Right. But if it's a brand new house for someone who's going to start their family there and have lots of goings on, I'm saying that because I don't have.
Well, it's like, the value is subjective to you, the person, right?
Exactly.
Right.
Exactly.
So I think that's one thing. And even the value can be manipulated to a certain extent, depending on demand, right?
Very much so. And that's the point that I'm trying to make. You're spot on. And so when we talk about value versus growth, we have to look at that, because there are all kinds of things that are going to affect some things or stocks value. So I just wanted to put that out there. And now let's talk about value versus growth. So when we talk about value and growth, we're usually talking about the PE ratio. That is the price to earnings ratio. How much do you pay for a stock versus how much that stock can earn you? All right. How much is the price versus the earnings? So you might think, well, if and it is P/E, right? So the E is on the bottom, earnings on the bottom. So the price that you pay to get those earnings is X, right? So you would think that, well, the price being small compared to the earnings, if the earnings being bigger, the big number on the bottom being bigger, that means you're willing to pay a smaller price for those earnings. Makes sense? It's a ratio, right? A smaller price for the earnings if the earnings are static. But we know that tends to be what we call a value stock. So what does that really mean to us? And if we can say the opposite as well, if the price were great compared to the price of those earnings, we would say that's a growth stock. So you can step back from that and say, okay, if it's a value stock, that is, I'm going to get value for my money. That is, I'm going to get earnings, more earnings for the money that I put on there. That's a great value to me. I've got X amount of that per price, $2. I've got X amount of earnings, $50. I put in 2, I'm going to get 50 back. That's not bad, right? We like that, right? You could certainly see how someone would call that a value,
right?
Versus a situation where a company may be new and they might say, well, it's going to cost me $50 and I'm only going to get $2 back.
Right.
Whoa, right? So we would consider that would be growth, a growth company. So now
Mm-hmm.
the question is, okay, what's value and what's growth? Well, in general, and this is why this is such a crazy thing, in general, depending on who's doing the judging, so depending on where that value and that price to equities ratio comes, the price to equities ratio doesn't change. That doesn't change. Wherever you are,
Mm-hmm.
that's the same. However, if you're looking at apartment houses in the Northwest, the price to equity ratio that is average could be one thing versus apartment homes in the Southeast. It could be something
Mm-hmm.
very different.
Mm-hmm.
So
Right.
which one do you go by, right? And then let's say if we take a look at apartment homes across the country and we see what their price to equity ratio is, and then we take a look at property homes um, across two countries, what does that look like? And I'll tell you this, that the average price to equity ratio is between 20 and 25. So that is to say that ratio, 5 over 20 or 25 over 5, or however you
Right.
get 25, 7 over whatever. So then what does that really mean by itself? And I'm just going to come right out and tell you absolutely nothing. Mean nothing at all.
Nothing. Nada.
Nothing at all. It doesn't help you make a decision at all until you put it in proper context, until you know what agency, what part of the country that you're looking at. Now, does it mean something to an apartment complex in the Southeast? Maybe. Does it mean something when you combine it with the price to book ratio and the stock price over the last 15 years and how long the company's been in business and all these other things and what kind of pies your grandmother made on Tuesday, whatever, those kinds of things, right?
Right. 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 Right.
Now that price to equity ratio means something. Now it fits in. And that's the only time you can use it, because if you just say, well, the price to equity ratio is 19, that's lower than 20 to 25, that must be a value stock, you are wrong.
But the average individual, well, I think they finally got the concept maybe buy low,
So,
sell high.
yes.
I think they
Yeah.
finally got that. But I think
Okay.
other than that, that's like right,
Yeah. Yeah.
right.
Okay.
They
So
just don't
now,
know.
yeah. So now that we know, A, how to compute the price to equity ratio, we take the price of the stock versus the amount of equity that it brings in. We know that. Okay. That's how they come up with it. What
Mm-hmm.
do we do with it? Well, if we step back, we get to talk about value versus growth as a concept. When we talk about value, we mean, and we're talking about the US stock market here. In my world, we mean stocks of companies where there's typically a dividend and the company's been around long enough so that they put out a dividend to attract more folks to buy their stock and to reward their stockholders so that they'll stay there and perhaps even buy more, right? So
Mm-hmm.
it's the idea of a value company. So these are companies, and I don't want to name names because they may not want me to do that. But these are companies that are generally folks you know. They're household names. They've been around forever. They're going to be around forever. These are names
Right.
you can, I'm not going to use the word trust, but these are names that you feel pretty comfortable knowing about, dealing with, working with, that kind of thing. Does that make
Okay.
sense?
Yeah.
Okay.
Uh-huh.
So those are typically, and I like using that word typically because it depends on where they might be, right? So if you're looking at the price of apartment buildings in the Northeast, but you compare that to the price of automobile sales in Texas,
Mm-hmm.
that doesn't make sense, right? Are you with me?
Mm-hmm. Right.
So you can't really, you got to make sure you're doing apples to apples, and you can't do things across the board. So we've established though that value companies, those companies that we attach value to, they've been around for a while. They typically have a dividend. These are long-term hold kind of places. These are kind of places where they want to reward their stockholders for buying that stock, so they're already well established. And
Right.
they want to entice people to come in to buy more stock because they're going to give them a dividend. That's those groups.
Right.
Okay. The opposite is true of what we call growth companies. These are companies, you may not know them. They could, I'm saying could, not necessarily. They could be dramatically younger. They could be companies that you've heard of, you just don't want to deal with them. They could be companies that their stock price goes up and down. So we generally want to buy those puppies, wait for a little while, sell that puppy. So I make tons, I have lots of friends, not me. I have lots of friends who look at value companies, and they tend to be really tiny things, like these little penny stocks, these little bitty things where they can buy, 700 shares for $7, and they buy these shares and they go up a penny and they go, oh, I made $8, yay! And then they sell it or something like that. So growth companies, we know about them or we don't know about them, and they tend to be a bit more volatile in the market, up and down, up and down, up and down. Okay, and we know that we're not going to get much earnings out of these pups. These are the ones with the very small earnings number. We might pay a lot for it and not get much for it. So, okay, so now we know what growth is, right? We have a good idea. We've got value, a bit less volatile, growth, a bit more volatile.
Right. Okay. Right? That makes sense.
So let's stick with a little bit less and a little bit more. That's probably the best way we can do that. And then we've got to put all those other things around it. Okay. So
basically what you're saying is because the growth with the growth, especially since there's so many different, they could be more risky than the valued companies.
Well, as a financial advisor, I don't like using the word risk. So if I could turn that around on you, I'd say they're a little bit more volatile in the market.
Okay. All right. I like that word too, volatile.
Yeah, up and down more. Versus value companies who aren't so volatile. They may go up and down a little bit or not much at all.
Exactly.
Okay. So when it comes time to look at our portfolio, if we're a portfolio manager, we have the opportunity to describe the kind of investments we're going to make. And we may say, hey, this is a value fund. I invest in those companies that are not so volatile in the market. They've been around for a long time. They give dividends. They are names that people have heard of, or they should have heard of. That's the kind of assets that I'm going to manage. And I'm going to buy and sell those kinds of assets depending on their stock price, their industry, what's going on in the economy, and what have you. So if we have a value fund, then it's a bunch of those. It could be anywhere between 50 to 5,000 of those companies. Right?
Right.
It's a value fund. And so then we have the growth fund, which is just the opposite. They go up and down. Boy, these are fast companies. Wow. Okay. So if I'm going to have both of those in the portfolio, then obviously we have a blend there, right? Okay, so what do I do with that if I'm an investor? Well, once you talk to your friendly financial advisor, and she tells you, hey, you need to get a well-diversified portfolio. All right, what am I talking about there? Well, obviously, in a way, if you have all growth in your portfolio, you're definitely going to be more, more able to handle the ups and downs of the market. Right? And you're going to be able to handle the ups and downs of the market to the fact where you're going to not recover, but as we were talking about last week, profit from, take advantage of growth in the marketplace.
And we should also remind everyone, this is a little bit different than, say, your individual stock portfolio. This is long-term, right?
It is, and that plays into it, but the concept is kind of similar because when we're taking a look at our portfolio, we've got a time thing there, but we're still looking at the same concept. We're still looking at value versus growth. So if I'm a financial advisor outside of my portfolio, outside of 401ks, I might say to someone, well, let's take a look at where you are. Let's put you on that scale. You take the test, find out what kind of investor you are, and that's going to determine what level of, and I hate this word, risk that you can handle in the marketplace that you're investing in, right? Right?
Mm-hmm.
Because if I looked at you and I say, you look like someone who could be a growth kind of person, that's not good enough. You have to have some way to determine that this person can actually handle the ups and downs in the market.
Okay.
Does that make
Okay.
sense?
Yeah,
So
it does.
the concept is similar, but you just have to make sure the arena that you're playing in, you have to let that define how it is that you're using the concepts, because the
Okay.
concepts are still appropriate. So
Okay.
when we're talking to that financial advisor, we're going to say, well, we need that person, he or she is going to say, you need a well-diversified portfolio. So that means you need to have, for most Americans, you need to have value and
Mm-hmm.
growth, large
Mm-hmm.
companies, medium-sized companies, small companies, which can be divided into value and growth.
Right.
You want
Right.
to have domestic company as well as international, which can divide it into value and growth. So when we
Right.
look at our portfolio, we could say, okay, and it doesn't matter if it's a 401k plan or not a 401k plan, we could say, okay, is it more value oriented or is it more growth oriented? And that's going to be determined by the answers that we have on that questionnaire.
Okay. Okay.
So if you have a financial advisor and they don't have a way of determining what your mix should be, like if that financial advisor says, you know what, you want to make money in the market? Yes. Okay, so you need to have these kinds of stocks. Okay, and these are the ones I'm going to suggest for you. Okay, I would run. Because he doesn't know you. That person
Right.
doesn't know you. They don't know what's going to keep you up at night, right? That's the kind of person,
Exactly.
right? That's the kind of person who, when you call them to say, hey, what's going on? Like my sister and her husband did. Hey, what's going on with our investment? They weren't there. They were gone, right? So they had put my sister and her husband into a very volatile stock that could have gone up, could have gone down. We don't know, without an explanation of telling them this is what that is, without explaining to the difference between value and growth, without knowing that. And so they made that decision. They put their money in. The market tanked. They couldn't get a hold of anybody, and now they don't trust the market.
And of
Actually,
course,
they just started getting back, but they
yeah,
didn't trust financial for a long time.
and I think there are a lot of people that, especially those that lost a great deal of their savings and their pension plans and their 401k. There are a lot of them that feel that way today because um you can't, and I understood. I mean, everything was super crazy and chaotic, but you had to at least provide some sort of comfort for the people whose whole life savings was tied up in their 401k and their whole life just changed, or their life plans and goals just changed before their eyes. So I could definitely see that.
Okay, very much so, right? So, what do you tell somebody, right? What
Mhm.
questions does that investor ask if they don't know the terminology, right? Because if you say to that financial advisor, "Hey, I just want to have X of a return," it doesn't work that way. If you say to that advisor, "Hey, I don't want to knock the cover off the ball. I just want to have something when I retire,"
Mhm.
that's not the right vocabulary. And I'm sorry about that, but we have a particular vocabulary and we have to educate you as the consumer as to what that vocabulary is so that we can both talk a common language so that we can get you what you want. So it's not a
Exactly.
question of you being lied to or you being misled. It is a question of being lied to and you being misled because you're not talking a common language. And it doesn't
Mhm.
do any better to, for me as an advisor, to yell louder in the language that I speak, or for you to yell louder in the language that you speak without us talking the same language. So it's an excellent question because value and growth are fairly specific concepts. You could say less volatile, more volatile, depending on where you're looking, right?
Mhm.
So the
Mhm.
same number could mean two or three different things depending on where you are. So, for example, the company that has houses in the southeast, their market may be more volatile than the company that has housing companies in the northeast. So then you
Mm-hmm.
got to take a look at that price to equity ratio to see price to earnings ratio. I'm sorry, to see which one means more volatile and which one and in what particular market.
Mm.
Does that make sense?
Yeah, and I think also what I'm hearing you say is that yes, that your advisor should be in a position and should be reaching out to you to make sure that your circumstances, what your current circumstances are at this point, but also you as the person whose money's being invested, you too should be much more active in understanding, or at least trying to acquire some understanding and asking questions of your advisor.
Yeah, I think you hit the nail on the head. Now that you know that value and growth can be subjective, the same number
Mm-hmm.
can be subjective. It's an
Mm-hmm.
excellent question. Am I more value oriented? Am I more growth oriented? Understand that
Mm-hmm.
concept. Growth, a
Mm-hmm.
little bit more volatile, value, a little bit less volatile. Just that. If you just knew that,
Mm-hmm.
ask questions around that. And if the advisor that you're talking to doesn't explain that to you so that you understand it and understand how it works in the portfolios that you're dealing with, you should leave them.
Yeah.
You should just say, you're not communicating with me. And that's one of the reasons why I'm an advocate of so many different kinds of financial advisors out there. I mean, we need advisors that can talk to people in their language so that they can all come back to the same language, which means P ratio, price versus earnings.
Mm-hmm.
Higher usually means growth, lower usually means value, depending on where they are. And how does that relate to a mutual fund and a mutual fund inside your 401k? Makes
Yeah.
sense?
Yeah,
Versus
it makes a lot of sense. It's because this is a topic, and like you said, it's the language. It's like the language of my world of accounting. If you don't understand our language and a banker's language, then you're not going to be able to give them when they ask you a question or for a document.
right.
You're not going to be able to give them the answer that's going to make them feel comfortable enough to give you a loan,
Yeah,
right?
right. You're not answering the question the right way. Even
Yeah,
though you got the answer, you're just not putting it in the right way. It doesn't fit in the
yeah,
whole. And
the
we just have to do
vernacular.
it that way because we need to give you the same answer, or we need to have the same language, let's say it that way, wherever
Mm-hmm.
you go, so that we can determine where you are. So if we can't determine that we did you wrong because we don't have the same language, we're in trouble as an industry,
Yes,
right? So
that's
we got
true.
to have a language. And then we have
Mm-hmm.
to make sure that you communicate to us in that language because we can't communicate to you in your language. We just can't. Number one, it's not what we were taught. And number two, we don't know what you're talking about.
Right.
And you're not going to
It,
tell us, right? You're not going to tell us. You're not going to say, well, my grandma, she cooks steak at 360 degrees because that's the way that my brother likes it and we've all liked it. I mean, we don't get that, right? We don't get
mm-hmm.
that background.
You don't have a history.
We don't have that history. So it's easy for us to give you a history if we learn all the same history. We all do. We learn all the same
Mm-hmm.
history. But then we have to communicate it to you. And that can be problematic if you don't have an open mind. So just to repeat, value versus growth, that deals with the price of the stock versus the earnings. Um, and typically, the lower the earnings, the more stable. And typically, the higher the earnings, the more growth oriented. So the more value oriented versus the more growth oriented. However, you cannot look at that number alone. You can't do it. It's like drinking a glass of wine and saying, oh, this is sharp. It just doesn't mean anything to anyone. What color is it? Where did it come from? What kind of grape is it? What is that? Right. So we
Mm-hmm.
have to get on that same
The
language.
particulars. You need the particulars so you could better advise them of what they're. And it's so funny. The other day, yes, I guess it may have been Saturday or Sunday. I came in. My brother-in-law likes old movies, so he happened to be watching Trading Places,
Mm.
and with Eddie Murphy
Mm.
when
Yep.
he was picked up on the street and they decided to trade places and introduced them to the stock market and all that sort of stuff. So there was a little bit of a segment within that, and they were changing the pricing and the value of concentrated orange juice. That's one of the commodities. And so the stockbroker was taking this guy onto the floor to show him how that was done and how easy it was to flip the value just by a yell into the crowd. And
Yeah.
then everybody started screaming, whatever they were doing. And then the prices dropped. And then the
Yeah.
other people who were manipulating the prices, right?
Yeah.
They're like, oh my God, our fortune is going away. And like, what are they talking about? No, no, no. And they should be selling. Why is the number going this way? And
Yeah.
it actually kind of explains quite a bit of what you're saying. And it's interesting that I walked in on that segment on Saturday.
Yeah.
But
So
right. And
the
so it was
universe
just
is
changing.
working.
Yeah. So one became wealthy, one lost all their fortune.
Yeah. Yeah. Yeah.
Yeah.
So just to repeat myself, value, less volatile, growth, more volatile. Stick there. And then once you get that concept in your head, what do you do with it? You put that in some other parameters and you come up with what's appropriate for you. Make sense?
Makes a lot of sense.
Okay. Can't look at that alone. Okay.
Right.
So that's value versus growth. Most Americans need both in their portfolio because they just can't handle being all one or all the other. Most Americans just can't handle that. Either portfolio. Right. Okay. And then make sure you work with a financial advisor that explains those concepts to you and explains where you are and why you're that way, has some method of putting you there before you start working with them. And if they can't explain it to you, get rid of them. Find somebody else. Okay.
True that. You want to make sure the person that's advising you on your money is equipped and compatible to your thought processes.
Right? Yeah, they are able to bring you into the conversation so that you both have a common language. Because if someone just says, for example, I have a colleague who just says, how old are you? 25. You should be in this portfolio. Why? Because you can recover. Fire him.
Right.
You got to have something else going on, right? Or, that's just like, have this apple pie. Why? Because it tastes good.
But he's basically saying that every 25-year-old is the same, basically, right? The colleague is that everybody is the same, but this is not cookie cutter. Because we all have whatever our own goals are, time frame, timing, family responsibilities. We don't come one size fit all.
Cool. And that's one of the reasons why I have a problem with target date funds. And I'm going to go out on a limb here and say this before we jump quickly to our other section. But I think target date funds, the ones that, they end in 2030, 2040, 2050, those kinds. I think they are wonderful inventions. But like everything out there, I wouldn't say it's a fly in the ointment, but you have to understand what it is that you're investing in. Like if you buy a 2-seater car, you have to understand that it's a 2-seater car, right? So you're not going to put your family of 4 in there. So when you have a target date fund, they have a professional advisor managing the portfolio, which is great. It's generally, I wouldn't say a very conservative portfolio, but not a very aggressive portfolio. So they have some stocks and they have some bonds in there. So that's great. The way they work is they typically have more stock than bond at the younger age. And then as the person gets older, they get more bonds in their portfolio. They have value and growth in their portfolio. We'll stop with that. So they're very well diversified portfolio, but they tend to be a little bit more growth oriented the younger you are. Now, the problem that I see with that is that every 25-year-old kind of looks like every other 25-year-old. For those of us that are 25, we're either, well, when I was 25, I was drinking beer, trying to figure out how to pay my student loans, and running around like I knew everything, right? So,
Mm,
and I was kind of like all most of my friends that were 20 to 25 years old. That's what we did. We got our first job out of college, and we are living 8 to a house or something like that, and we're trying to make it. That's
right.
what we do. By the time we get into our 30s and our mid 30s, some of us have gotten married. We're looking at that first child. We are looking at moving out of that anthill into something different, right? And so
Mm-hmm,
our
mm-hmm.
lives are starting to look different. And certainly by the time we get to be 40, our lives look totally different. Some of us
Right.
have, we've got aches and pains that we didn't know that we have. We are becoming really, really good at what we do in our profession. We are dramatically different people. We got a house, maybe even got another house. We've got stuff going on. So to think that every 40-year-old looks like every other 40-year-old, that to me is a misnomer. And so
Yes.
that's why I think that if you're going to do the target date fund, you have to really know what it is that you're getting involved in, because they are wonderful for people that have that fire and forget mentality. But you have to understand that if you use that fire and forget mentality, you're going to look like your investments are going to look like everybody else that's that age. And that's it.
Right.
It's just
Right.
me,
Right.
right? It doesn't have
Yeah.
anything to do with where you live or all the other parameters that are important that make you you. It's just your age. Now, some companies have value oriented, like you can be a bit more conservative in your target date, or you can be a little bit more aggressive in your target date, and we can fund you, we can play with it a little bit to get you there. But
Mm-hmm.
it's not like having your own portfolio, which I think
Mm.
after the age of 30, I would say you really need to get your own portfolio. That's my opinion.
Okay.
Don't don't take it for gospel. That's it. Because there are some people who say, you know what, looking like every other 30-year-old or every other 50-year-old is fine, as long as I don't have to do it. That's what some people are
Right.
saying. God bless them if they do. Right? That's fine.
Right. Right. Right.
Okay, so let's talk about what do we do when we leave the company.
Big question now, because the reason I was attracted to the article was because we're so supposedly going through the great resignation time frame, whatever that means. But so a lot of people are making some emotional decisions. And those emotional decisions may have some future consequences
Oh
if you
yeah,
don't know exactly how you're navigating this. So I thought this
yeah,
was a good topic just because of that. So, and I
yeah.
obviously you did too. You did as well.
Yes, yes. I'm so glad that you presented it. I get stoked when I talk about it because when an employer considers this with regard to whether they're going to start their plan or not, it really means they really, really care about their employees. And I think employees should realize that. Number
Right.
one, the employer starts the 401k plan. So he or she is helping you with your retirement. That's big
Right.
because not their responsibility to do that, it's yours.
Right.
So that's big. And then if they start the retirement plan to make your job of saving easier, then they put a match on there. That is, they're going to pay you more money to help you save. That's huge. I don't know
Mm.
any medical professional that will give you extra medicine just in case you need it, right? I mean, it's your job to tell them, but they're not calling you up every Tuesday to say, "Hey, yo, Jay, how you doing, man? You need to come in. What's up?" They're not doing that, right?
No. Mm-mm.
So it's a very big thing that they're helping you. So let's take a look at what happens when you happen to leave that employer and you need to go someplace else. Maybe something like yourself. Many of your clients, rather, not yourself.
Mm-hmm.
Many of your
Mm-hmm.
clients, where they're going to do their second act or maybe their third
Yeah.
act. So what's that? All right. So number one, um, if you have a employer sponsored plan, all the money that you put into that plan, all of your money that you put in, it's yours. It's what we call 100% vested. That is, vesting means ownership, right? So
Okay.
the minute you put it in, it's your money still. So if you leave that organization, it's still your money. It doesn't belong to the company. It belongs to you. and you have it invested not in the company, but
Mm-hmm.
at some investment house that you've heard of, some big insurance company or some big stock company or some big company that manages 401k plans. So no matter what happens to your company, if it folds or grows or whatever, that does not affect your money. It's still
Okay.
yours. It's still in the market, doing whatever it's doing in the market. Okay. How much of that do you get to take with you? If it's your money, all of it. You're always 100% invested in your money.
Okay.
Okay. Now, let's say the employer kicks in some money to help you, a match. If they do what we call a safe harbor match, that's usually, not all the time, but usually a 4% contribution. And it's usually broken down two ways. Two ways. The first way is you contribute 100% of the first 3%. So you put in 1%, they put in 1%. You put in 2%, they put in 2%. You put in 3%, they put in 3%. You put in 4%, they put in 0.5%. And then you put in 5%, they put in another half. So it's a dollar for dollar up to 3%, and then 50% on the next two. So you have to put in five in order to get 4.
Okay.
So your
Okay.
company, employer puts in 4, you put in 5. Right? That's how you get there. So that's 9. That's pretty
Mm-hmm.
good because most financial advisors realize that most Americans don't start saving until their mid 30s or early 40s. So we got to catch up, which means we got to take more volatility in our portfolio so that we can profit from the downturns when things go up. Because if we had started earlier, we could take less volatility, right? If we start in our 20s, we can take dramatically less volatility in our portfolio to reach the same goal than if we could if we start in our 40s. Does that make sense to you?
Mm-hmm. Mm-hmm.
Are you with me?
Yeah,
So
I
I got
am.
to take some, yeah, I got to take some big jumps in my 40s. Where if I started in my 20s, I could take little jumps the whole time. In my 40s, I got to take
Mm-hmm.
some big jumps. Okay, so
Yes.
if you're what they call a safe harbor plan, that whole I put in 5 as an employee, my employer puts in 4%, I'm at 9. Most financial advisors say I got to have between 10 and 15 because I started kind of late. I'm pretty close to that 10. I'm doing pretty well. That's pretty
Okay.
good. It's pretty good. Um, all of that money that the employer contributes in your safe harbor plan, all of that is 100% vested right now. So as soon as they make it, it's yours. No matter what happens to the company, doesn't matter. As soon as they make that contribution, it's yours. That's only the safe harbor plan. So the question for you as an investor is, okay, how much can I put away? I'm going to put away $19,500. All right. What percentage of my pay is that? That is 10% of my pay. Okay, great. So I'm putting 10% in. You put your 10% in, right? The first 5 you put in, your employer is going to match 4%. So you put in 10%, which is $19,500.
Mm-hmm.
1% you put in, they match. 2% you put in, they match. 3% you put in, they
Mm-hmm.
match. 4%, they only give you 0.5%. 5%, they give you another 0.5%. You put in 5, they put in 4. That's safe harbor. We'll go into
Okay.
why they created safe harbor in a little, maybe at another show, but that's a
Okay.
safe harbor plan. That's how that works. The safe harbor plan is the only plan that's mandated by law to be that way. And that
Okay.
is number 1, the people have to stay there no longer than a year to be involved in the plan. Number
Mm-hmm.
2, the employer matches 100% vested as soon as the employer puts it in your plan. And then
Mm-hmm.
number 3, you can, those are the big ones. I would say
Okay.
number 3 is, you can take that money with you. So when you leave the organization, that money is 100% vested, just like your money. You can take it with you, roll it into an IRA, roll it into your new company's 401k. If you have more than $5,000, you can leave it there in the organization. If you have less than $1,000, they're going to send you a check. We'll talk about that in just a minute. So just
Okay.
understand that the money is yours, subject to that vesting
Okay.
schedule. Okay, so let's say you say to your employer, okay, I'm ready to get into the 401k plan. Is it safe harbor? And they say yes. And you say good, because now you know all that money is yours. You ask them, is there a 401k plan? They say yes. You ask them, is it safe harbor? They say no. Not a safe. Okay. Is there a match? They say yes. There is a match. What's the match? Well, generally the match is either what we call a 3-year cliff or a 5-year cliff. But the way it works is that the employer is going to have claim to the monies that they've contributed dependent on the years of the vesting schedule, depending on the vesting schedule. So you'd have to talk with your financial advisor to find out exactly what it is. But just for example, they could have a 3-year cliff to where the first year that you're working there, you go from 0 to 1. And then the second year, you go from 1 to 2. And the third year is 2 to 3. So after 3 years, you are 100% vested. But you got to work those 3 years to get 100% invested. Once you've worked the 3 years, all the money is vested. Doesn't matter. All the money, the money that you contributed on year 1, year 2, year 3, that's all 100% vested. You've worked there 5 years. You get to take all that money with you, roll it into an IRA or 401k. Does that make sense?
Yeah, let me ask this question. Oh, my computer's on low right now, but ask this question. So since this article is talking about the Great Resignation, so if I was working at a company, but my 3 years is not to January, but I'm thinking of resigning now in November, a month and a half short of my 3 years. So am I only taking the money that's mine that I've invested, but because I'm not totally vested yet until that 3-year period, then the match is not, that's not mine, right?
So it depends.
Okay.
It depends on how they calculate it, and the way they calculate it is spelled out in the plan document, and most people
Okay.
don't read the plan document. But in general, there would be a situation where if you're at 2 years, you're good. You get the 2-year money, right? At 3 years, you get the 100% of all the money. Does that make sense? So at 2 years, you would get all the money that you had been invested to for 2 years. So let's say that's
Okay.
75% of your monies. And then at 3
Okay.
years, you would get the whole thing.
Oh, one.
That's
Okay.
generally how it works.
Okay.
It's not. Now, I have seen some plans where it's 5 years or nothing.
Wow.
I have seen that. Right, so you got to work 5 years. If you work 4 years, you don't get anything. You work 2 years, you'll get nothing. And it's those meetings I would say, look, if you know people that want to join this company, make sure they leave before 5 years, because if they leave before 5 years, you get their money. Right? The employer's not going to put it back in the pocket. They're going to use it to reduce plan expenses, or they're going to share it with employees. They're going to do something with it, right? So there are those companies out there that will say, you got to work here 5 years. If you work here 5 years, all the money that we put in up to those 5 years, you get to keep that. Plus, all the money you make, all the money we put in past your 5-year thing, your time thing, you get to keep that too. Right? So you have to ask them what it is. Sometimes they're graduated, sometimes they're a cliff. If they're graduated, you get a percentage. If they're a cliff, you got to work 3 years before you get there.
So one should be thinking about that before one just runs off into the abyss.
especially like a November, January thing, right? They'll be like,
right.
I mean, some companies, it depends on the document, how the document is written, and depends on how the employer feels. But he says, look, you leave me after 3 years, okay, cool. But if you leave me after 2 years, I'm not giving you anything. Ouch.
Yeah.
They can write it that way in the document.
Okay.
Or they'll say, look, we just want to make sure that if you're here for a year, we give you what we owe you for a year. If we're here for 2, we give you what you owe you there. So it really depends on what's in the plan document. There isn't a universal.
Okay. That's good. Correct. Let me ask this question, and you probably are getting ready to go into this direction. When we first started this I think last year during the pandemic, um, for there are individuals that actually took loans or some sort of distribution from their pension plans in order to survive if they didn't have any money coming in, right?
Yes. Yes.
They were given that allowance to do so, and I think
Yep.
it stopped in December. So what
Yep.
happens if I now I needed that money at that time, so now I'm getting ready to resign. Is
Hmm.
that do I have to pay that loan back now, or how is that going to affect those that actually are leaving their jobs now?
Okay, so it depends on when you start the loan. If you started a loan during that special time period, and I'm a little rusty there, but I believe you would have 3 years to pay it off, and you'd have this particular interest rate, and it was like um, it was a special consideration, right?
Okay.
So in that case, you're paying on the loan now at that particular rate, right?
Mm-hmm.
Okay. Depending on how much of the loan you have left to pay, you can decide I'm going to pay it or not. Most companies will say, if you don't pay it, then we're going to tell the IRS that the loan has been defaulted on, and whatever part you have left out there, you have to pay tax on it. It becomes
Okay.
income to you. So if you
Okay.
borrowed $20,000 and then you leave that company and you still owe $10,000, that $10,000 becomes income. You add that to your modified adjusted gross income, and whatever bracket you fall into, that's the level of tax that you have.
Okay.
Makes sense? So they don't tax that specifically; they just add it to your income.
And then the next year, you may you'll be paying on that particular capital gain, as one speaks,
Well,
because
that's different.
because you defaulted on the loan, you didn't pay the loan back, so it's actually um
Just
income to
add it to
you.
your income.
Yeah.
It's just
Okay.
added to your income.
Income.
And depending on when you leave, right? If you leave in October, then it's added onto your
Oh, this
2021 income
year's
this year. Yeah. If you
it'll be
leave,
for 2021.
yes,
Okay.
yeah, you just added
Got
that $10,000 to your income. So that's why we
okay.
say it's taxed. But remember, though, it's not just that income; it's your whole income. So if you only have $3,000 left, that's usually not going to affect your income tax bracket all that much.
Okay.
You know what I mean? So
Mm-hmm.
you could say, well, I'm just not going to worry about that. But if you
Mm-hmm.
owe $20,000, now that's going to move you up a couple of brackets. Does that make sense?
Yeah.
It's like adding $20,000 to your income. Right, so you got to come up with that cash. So that's
Okay.
something to think about. How much do you owe, and what are you going to do with that? And you could pay it off, though. I mean, you could pay it off. That's something to do there. Now, here's the deal: if you have less than $1,000, most companies have within their document that if you have less than $1,000, we're going to send you a check. So we send you a check. You got that loan out there. You get the check, and you gotta put that extra money on your income for your taxes. That's how you pay
Okay.
taxes.
Okay.
If
Mm-hmm.
you have more than $5,000, legally they cannot send you a check. So you legally can leave that money in the plan. Now, do you want to do that? I would say probably not. Probably not. And I say probably because there are some companies who want you to leave the money in the plan. So let's go back to that first situation. $5,000, you get to leave the money in the plan or roll it into an IRA or
Mm-hmm.
take the cash, which I don't think you ought to do. You
Mm-hmm.
cannot take a loan on it after you've left. So you can't take a loan, and you'll either have to pay that loan off that you have on it, but it's still in those investments. Does that make sense?
Yeah, it does.
Yeah. So
It does.
the scenario would be, all right, I borrowed um, I borrowed 10 grand during the pandemic. I paid quite a bit of it off. I got $5,000 left, and I want to leave the company. All right, $5,000 to pay on my loan. Okay. I look at the amount of money that I made this year and I go, $5,000 added to my income. That's really not going to raise my taxes that much. Fine. I'll just let it roll, pay a little bit extra money, and off we go. Right. Or you can say, whew, okay, so I borrowed $10,000. I got 5 left. I'm moving to another company. I'm just going to pay that $5,000 off. Let's pay it off. Pay that money off. Now there's no taxes, no muff, no fuff, and you go on about your business. Roll your money into an IRA or roll it into your new company's 401k. Okay. Makes sense. And then the second scenario is, all right, so I borrowed $20,000. I got $10,000 left here. I can't pay it off. I had to leave for some reason. I can't pay that $10,000 off. I don't have the money to do that. I'm going to have to default on that loan. That's just the way it is because I can't pay it off. Okay, now that $10,000 is going to be added to my income, and that's going to increase my taxes by however much money, and that's how much I got to pay the government at the end of the year.
Okay, so one should be not so emotional in this process. One should be thinking about all of one's eggs, making sure all the eggs are in their own proper containers. So,
and it is good to find out, what is going to be the policy, but know in general that if it's over 5 Gs, you can leave it in the plan.
Yeah.
Yeah.
And then if it is over that, then if you're thinking responsibly and spoken to your retirement plan advisor, you can roll that into your IRA or to a Roth, right?
It would be difficult to roll it into a Roth because if you roll it into a Roth, you can only put after-tax dollars into the Roth.
Oh, okay. But you could roll it into your IRA.
You could roll it into your IRA. I would say that.
Yeah, IRA.
Yeah. If it's Roth money, I would roll Roth money into the Roth IRA. If it's regular money, and you probably want to talk about this with your financial advisor, but if it's regular money that you have in a down year in the economy, you can pay the taxes that you owe on that pre-tax money and then roll that into a Roth IRA, subject to the limits, right? Does that make sense? Okay.
Yes, it does. And then anybody else that's close to retirement, then the same the conversations we've been having over the past couple of weeks, you follow suit, right? If you're close to retiring and having to make the decision between Social Security and retirement, then you continue as you would under normal circumstances. Just those that are younger and could be more affected by this process than the older ones. Because 5 years, because my understanding is we've been saying that if I was retiring, I wouldn't be just doing that right now. I would have started talking to you about 4 or 5 years ago, right?
Exactly. Yes.
Okay. So whatever the plan is, 4 or 5 that I've been working on to get me to that magical date, I would still follow suit in the advice that my advisor gave me.
Yeah, because you talked with your advisor before you did it. So you put together the plan. Yes.
Yeah, we already have a plan. So I'm going to follow suit on my plan.
Exactly.
Okay.
Okay.
A lot to think about.
It is. Yeah. I wrote down on my notes 1,000 to 5,000. Thanks for bringing that up. Loans. Thanks for bringing that up. Okay. And IRA versus leaving. Thanks for bringing that up too. So I didn't even have to follow my notes, Crystal. You just hooked it right up. Took me right through there.
We're in sync.
Yes, that's awesome. That's totally awesome. I don't even know how to wrap that up. We are at the end of our hour, but just know that, except to say, you have to talk with your financial advisor because all plan documents are not the same, and you can do some legal stuff. Oh, the last thing is some companies, they want to hold on to your monies after you've worked there for, let's say, 5 or 6 years, because they're afraid that guys like me will try to snake it away and be dishonest to you. And they feel that the guy that they have is a better person because they know he's not interested in snaking your money away. So there are some companies out there that are a little bit more paternalistic and they encourage you to leave the money in the plan. And they have little programs set up to where they will dispense monies to you on a regular basis, or they will put money into an IRA for you, or they will do something to encourage you to leave your money in the plan just to protect you. It's a trend that I saw, I want to say about 5 to 6, maybe about 8 or 9 years ago, where companies were being a little bit more paternal and trying to protect their participants from unworthy financial advisors or people that would do them harm by keeping that money in the plan. Make sense?
Makes sense.
Yeah. Okay. So we've come to the end of our show. Man, this was exciting. I was thinking we weren't going to have enough to talk about. This is cool. Let me read your bio one more time, and then we'll close out. So my friend and colleague, Crystal Mitchell, she is a business coach and consultant, CEO of Mitchell Business Solutions. She's the co-director of Recycling Black Dollars. She's a co-host of The Business Zone with Crystal and Gilbert, another weekly radio show. She's an instructor at Mount San Antonio Community College. She's the AA Certified Network for Teaching Entrepreneurship Instructor. That's pretty cool, actually. And she's a QuickBooks Pro Advisor financial strategist. Thank you, Crystal, as always, for being on the show with me and asking those great questions. I'm Jevon Thomas. I'm a licensed retirement plan advisor. Crystal, I'll leave it to you to have the last word.
So basically, guys, the more information you have, the better decisions you make. And I think these topics were all about that, not making emotional decisions, but actually having information that you've spoken to your advisor, your team member, your financial team member, to make sure you're making the right decisions for yourself. So that's really all we're trying to do. We don't want you to be that guy.
We didn't even get to talk about that guy.
Right. But whatever it is, we don't want you to be that guy. We want you to be an informed individual, making sure that you're speaking to people that are qualified to advise you on your financial situations.
Excellent. Okay. We'll see you next time on Conversations on the Patio. Actually, I hate to spring this on you, but I will be out of town next week and the next week, actually. So we'll have to come back to you in maybe 3 weeks and get that thing going.
All righty. I think everybody else will be on Thanksgiving holiday, which is next week. I will have had a crazy weekend. I have the Black Business Expo on Saturday, and I'm emceeing it. And I have my business camp, my biz camp, entrepreneurial kids going to be participating. So by next week, I'm going to be wore out. And I'm taking some children to see King Richard at the movies.
Good for you.
Yeah, we're taking our kids, one of those kids to see. So it's going to be a very busy next 10 days. So we both will need to rest.
Most definitely. Thank you, Crystal. Goodbye, everybody. We'll see you next time. Bye-bye.